This is an overview of accounting theory, and it's prepared in two parts. This is part one. A comment that I sometimes receive from the accounting students that I teach is that there is no structure to accounting. The practices that are in current use appear to be a loose gathering of disparate items. In this module, I will present an overview of some of the underlying principles used in the development of accounting standards. My objective for preparing this module is to present material that will hopefully assist students in developing an understanding of this process. This is Chris Martinez. I teach accounting at a community college in Toronto. Here is the agenda for the presentation. The first issue covers the criteria for inclusion of transactions in the financial statements. This is followed by the evaluation of those transactions at time of first inclusion, and later the subsequent changes made to the initial valuation. The final section covers observations about the financial reporting process and some concluding remarks. What are the criteria for recognition of items in the financial statements? The statement of financial position for a business has been likened to a photograph. Generally, if a transaction involves a direct link with a business, then it is included in the financial statements. For example, payments to suppliers or sales to customers. However, some economic events without direct linkage to the business may be included. At the present time, criteria have been identified to permit inclusion to the financial statements. The FASB and IASB have separately defined the elements of financial statements and have set out definitions of each element. Listed on the slide are the elements of financial statements for both the IFRS and the FASB. While there are some differences, there are also many similarities. The definitions also include the concept of measurement. If the economic event, in general terms, meets both the definition of an element and is measurable, it is then included in the financial statements. What is the rationale for developing the criteria for inclusion in the financial statements? A good starting point is to look at the origins of accounting. Unlike the sciences that are governed by the laws of nature, accounting is not constrained in the same manner. Some historians believe that the growth in trade was influenced by the needs of those providing capital to the venturers, and that a system of accounting was introduced to meet this need. Luca de Pacioli, who lived in 15th century Italy, is credited as the first to document the double-entry system of bookkeeping, a method that is viewed as the precursor to the accounting structure that is in use today. Since that time, there have been many changes and expansions to the accounting structure. The content of financial reporting is constantly evolving, as mentioned earlier. But what should be included in this reporting? One of the tenets underlying financial reporting is referred to as decision usefulness. The information appearing in the financial statements should provide a benefit to some person or group who wishes to understand the financial aspects of the business and to make some decision. The providers of capital were identified as the group that provided the impetus, very likely, for the development of double-entry bookkeeping. Since that time, a number of other groups have been identified as having an interest in the financial aspects of a business. Who are these users? What are their information needs? The users of financial statements include present and potential investors, creditors, employees, donors, ratepayers, competitors, regulators, tax authorities, and others. The types of decisions may include, for example, investment or disinvestment, the offering or retraction of credit, solvency considerations, assessment of management performance, and the efficiency of operations. In view of the wide variety of users and types of decisions, it may not be possible to meet the information requirements of each of these user groups through use of the organization's financial statements. At the same time, there may be overlap among the requirements of the different users. However, it is likely that each of the user groups have some information requirements that are unique and not included in the requirements of other groups. Consequently, the full information requirements of each of the user groups may not be met. At the same time, other sources of financial information outside the financial statements may meet some of these requirements. If the required information is still not available, a potential investor may not proceed with the investment, may reduce the size of the investment, or, in the case of a creditor, may insist on a shorter repayment timetable. Other investors who experience continuing dissatisfaction with the financial statement presentation may express their dissatisfaction through political means. In response to the diverse and evolving information requirements of users, a position that is often discussed is to provide extensive disclosure of the circumstances and not be restrictive on the accounting method used to report that item. The rationale for this approach is that the user of the financial information is able to reconfigure the accounting treatment in a manner that best suits their requirements. The criticism of this approach is that it requires a sophisticated reviewer, which may not be a reasonable assumption. In addition, the quantity of the information presented in the financial statements may cause information overload and may reduce comparability among other businesses. In summary, because of the existence of various user groups with different user requirements, it may not be possible to fully meet the requirements of each user group. The approach adopted by many of the standard setters appears, in my view, to place a priority on the needs of investors and creditors. This is the end of part 1.